Hello friends, Ivan Oberon here, your favorite real estate lender. And today in this edition of Mortgage and Mindset Minutes, we're going to be talking about a little thing called debt to income or DTI and how it relates to mortgage qualifying. First, there's different types of loan programs out there. There's everything from the ones you've heard of, the conventional, conforming, FHA, VA, jumbo, super jumbo. There's also investor specific loan programs, and they all have their own little way of calculating debt to income. So from a very basic standpoint, anything that's going to be a conforming or high balance conforming loan and also FHA and VA will generally have a maximum debt to income of 50%. Okay, that means that all of the liabilities on your credit report, including the new principal, interest, taxes, and insurance for the property that you're looking to buy or refinance, which also includes HOA if it's applicable, has to be no more than 50% of your actual qualified income. Okay, now there's some exceptions that can be made through FHA and VA that can have that debt to income be higher, but that's a good general rule. Now on jumbo and super jumbo, a general rule for those more typical programs is going to be 43% debt to income. So as you can see, the bigger loans are a little bit riskier for the investors, so they try to be a little bit more conservative and knock that debt to income down. And there's also some other overlays and different things like reserves and other things that they put on there to make it a little bit more challenging to qualify or make sure that that borrower is more well qualified than on your non-jumbo products. But also that's the general rule. That being said, I do also have a 50% debt to income jumbo loan, and there's other ways that we can get creative as well so that you don't have to necessarily put 20% down minimum on a jumbo product. Even if you don't have the 20%, we can still work with you on a larger loan. So those are kind of like some general rules. Now, what about some of the investor programs? What if you're self-employed or you file your taxes a certain way or just don't show income for whatever reason, but you're interested in an investment property instead of maybe a primary residence for yourself or a secondary residence? Now the debt to income, if you will, turns into a little word called DSCR or debt service coverage ratio. And that's just a fancy way of saying that that's the DTI of the property, not the borrower. So similar calculation, it's still going to be based off of that property alone though. If you have other debts outside, other mortgages, they won't count those. But the rent or the income of the property itself has to be a minimum of 100%, or the expenses can't exceed 100% of that income. So that's a really cool tool and a program that we have available. And the rates are also awesome under those programs, especially now that there's growing or shrinking the delta between private money and non-QM rates versus conventional rates. Now that the conventional rates are going up a little bit, the non-QM and private money rates have not. So they're getting very competitive in this space. So I hope that helps. Let me know if you have any other questions. If you want to see a list or have a conversation about what items specifically they look for debt to income, because things like your utilities and other expenses like that aren't factored in, thank goodness. And what I'll leave you with as far as the mindset piece is to make sure that you always remain future oriented. I've found out that really successful people spend very little time in looking at the past, talking about the past, and even reminiscing about the past. They're focused on today, and they're always looking towards the future of how can they improve what they need to do today to move them to where they want to go in the future. So until then, and until next time, hold your vision for the life you want to create. We'll talk to you soon. Have an awesome day.